What is the yield curve? But more importantly, how do we utilize the yield curve to understand the market and what impacts rates? I've really outdone myself on this one. Please watch it all the way through for it to make the most sense. The yield curve is made up of treasury issued debt. These are considered safety assets because they are backed by the full faith and credit of the US government. Once we know how much we need to fund, the treasury auctions off the debt with different maturities. And they announce this in advance. They say, this is how much we're auctioning off. This is the date that that auction is going to happen. And here is the maturity of when that expires. For example, they may need to auction off 150 billion. So they do 100 billion that expires in 12 months and then 50 billion that expires in 10 years. During that auction process, yield is determined. People who are participating in the auction say, okay, I am willing to take on the debt of the US government. I think you're going to pay me back. But in order for me to take on that debt, I demand this much yield. This is the interest amount that the government then pays to the person buying that. Just stay with me. So on the y-axis, you have yield. On the x-axis, you have maturity. And all we do is connect the lines. Earlier issued maturities, say this is 0.5% or so, and then the 5-year is a little under 2, the 10-year is around 3, and then the 30-year might be around 5. That creates the yield curve. If you have shorter term debt, you're going to pay less interest than on longer term debt. And you have to be compensated for that debt when you're demanding yield. You say, if I think that the economy is going to grow more, I expect higher yield because I could be parking my assets in the stock market and businesses rather than fixed income products like government debt. So therefore, give me higher yield. Basically, the stock market and the treasury market, the fixed income market, are in like this little love triangle and they're competing for your love. We separate the yield curve into the front, middle, and long end. So you might hear that a lot in finance media. The front end is made up of treasury issued bills. These are shorter dated maturities. The 5-year are called treasury issued notes. This is the middle. It's 2 to 10-year issued maturities. And then the long end is called treasury bonds. And those are 20 to 30-year issued maturities. And they all affect different things. The front end of the curve affects your high yield savings account and your credit card. The middle is your auto loans and mortgages. And then the long end are corporate loans and student loans. What the government pays on your debt also is what you pay on your debt. Now, I want you to really think about that statement for a moment. If I'm demanding higher yields, I expect there to be growth of some sort. I may even expect there to be inflation. I want to be compensated for some reason, which means where yield is on the curve can give us an indication if